Good afternoon, guys, and welcome to today's reverse mortgage webinar, one of my favorites. I'm Cindy Bishop with Cindy Bishop Worldwide, and it's a pleasure to introduce our esteemed master instructor for today, which is Kelly Catalinas. Kelly is a seasoned mortgage loan officer with over 3 decades of experience. Kelly has not only excelled in her career, but has also become a leading lender and branch manager. Her expertise extends to training agents and lenders, enhancing production, and cultivating lead generation. I should add one more thing to that. I think Kelly is one of the best I've ever seen in the protection of her clients. I have to say that because not everybody is. Okay. So I just wanted to mention that. In recognition of her outstanding contributions, Kelly has been honored to receive the Lifetime Achievement Award by Washingtonian Magazine. Additionally, she has received the 5-Star Professional Award for the 4th straight year, which has been bestowed only on 3 people out of 4,600 individuals in the Washington, D.C. area. That was in 2024. They haven't done 2025 yet, I'm
No,
sure.
they did. I got it. I
Of
haven't.
course you got it. Like, let me make sure you update your
I'll
stuff.
update.
I
Thank
figured it was
you.
probably right around that time.
Yeah, they do
These
all the announcements like around October time
yeah, these
too.
are just a few of the many
Thank you.
professional awards that Kelly has received. What truly sets Kelly apart is the trust and admiration she's earned from her clients and agents, with only 95% of her business coming from referrals. Today, Kelly will share her expertise on reverse mortgage, which I think is really critical for people to understand when they get closer to retirement age, because you want your quality of life to be better. Don't worry
Mm.
about leaving stuff to the kids, although I do, but still. So without further ado, let's join me in extending a warm welcome to Kelly. But yeah, that's really important, because even though it's a little bit, hard when you're going from a 3% mortgage to whatever, but it's about extending that money. And I just went to the grocery store. Okay. My same cart of food was $100 more than it was 2 weeks
Mm.
ago.
Mm.
$100 more. How
Wow.
the heck are people on a fixed income going to survive?
Right.
Okay. So I just wanted to
Well,
make that
thank
point.
you.
That's why
Thank
this is
you.
so good. You're welcome.
I appreciate that. And thank you everybody for joining. We have a small group today. So as we go through this, if you have a question, you could put it in the chat or you can unmute. If it's small enough and it's urgent enough, chances are other people have the same question. I am very excited to talk about reverse mortgages. I really believe that it is a wonderful retirement tool if you think of your home a little differently than just being the place where you lay down each night. So we're going to go through the introduction to reverse mortgages. I want you to really kind of change your mindset and think about it like a retirement mortgage. We'll talk briefly about the loan qualifications for this program, different ways you can use a reverse mortgage as you retire, what happens to make the loan mature, what's a maturity event, and why Fairway, there's not a lot of time on that. We're just one of the largest reverse lenders in the country, pretty much. And today we're really going to focus on the most popular reverse mortgage program, the one that basically 95% of all reverse mortgages are conducted under this program. So there are other reverse mortgage programs, but I'm going to focus on one very specific one today, and we'll get into that. So again, we always talk to our colleagues and I can ask the question, what is your opinion of reverse mortgages? Inevitably, we might have a handful of people that say they're great because they know somebody that has used one effectively in their retirement planning. Or more likely, we hear, well, I've heard some bad things about them or some strange things about them. But I have an open mind and I'm trying to learn more of the facts of where we are today. And that's a good attitude to have because it's not like it was when they first rolled reverse mortgages out to the public many years ago. So we'll get into that. If you ever read any books by Wade Pfau, he does extensive writing about how a reverse mortgage, when used strategically, can greatly improve the sustainability of your retirement income. over time. So there's a lot of things that he writes about why reverse mortgages are better to get when you're younger than when you're older or as a loan of last resort because of its strategic use as you age. So we'll get into that as well. So primarily the questions we asked are if you are aged 62 or older and are concerned about market volatility with where your current assets are currently housed, and inflation, which everybody is concerned about inflation regardless of your age. But outliving your savings is probably one of the major things I hear when I talk to people about reverse mortgages and the concern that they will run out of money and have to sell the home that they call their home for many years and don't want to leave. Okay. How they'll be able to make monthly mortgage payments in retirement, and not just about the mortgage. If they own the home free and clear, but taxes and insurance continue to go up each year, but their fixed incomes do not, that becomes a very real concern as well. Not being able to live in your current home in a safe, sustainable way, meaning you love your home but maybe as you age, it's not meeting the requirements of aging. You know, it's got too many floors, it's got too many steps, the doorways need to be widened. Maybe you're walking with a walker or a cane or a wheelchair, and you still want to remain in your home. How are you accommodating you aging in place? Okay. A reverse loan could be a solution for a lot of these things. So it is a loan that is exclusively for older adults. The loan program we're going to talk about has a minimum age requirement of 62 or older. It converts a percentage of the equity that you have in your home into tax-free cash. You are not required to make any principal and interest payments on this home loan. Okay, you still have to make your taxes and insurance payments. Nothing changes with that, just like on any mortgage you've ever had. You have to pay your property taxes, you have to pay your homeowner's insurance. But the principal and interest payments for the mortgage loan do not have to be made in a reverse mortgage situation. Okay. The program I'm going to talk about today is the home equity conversion mortgage, which is a loan that is made through the Federal Housing Authority or FHA. So for realtors on the call, think FHA loans, FHA property standards, FHA government financing. Okay. It's the most used reverse mortgage in the United States. It launched in 1989, but it's far different than when it first rolled out all those years ago, because there have been many, many amendments to it that provide additional consumer protections, not only for the person who is living there, but for the heirs to the property should that person pass away and the heirs want to keep the property. It's the only reverse mortgage that is insured by the Federal Housing Administration. Okay, so again, you've got mortgage insurance premium. You're all aware of MIP on FHA loans. This loan is no different. Okay. And again, it's exclusively for those age 62 or older. So people will say, well, we're only going to do a reverse mortgage as a loan of last resort. You know, isn't that what this is for? You know, the borrower has run out of options in terms of cash flow monthly. I would stress that a reverse mortgage has such wide appeal, and for the savvy investor, you would, and your financial planner would easily see the benefit of a reverse mortgage in terms of the way it can be used for you to maintain those assets in accounts that are growing at a faster rate than what your reverse mortgage might be negatively amortizing. Okay, so we'll get into this in a little bit. But there are primary reasons to get a reverse mortgage. Sometimes it's to address an urgent need maybe someone needs in-home care. They own a home free and clear. They've depleted their resources. Their health has dramatically changed. They want to tap into the equity in the home as cash, but they don't want to be required to make a mortgage payment after accessing that equity. Okay. Sometimes people look at a reverse mortgage as lifestyle enhancement. Um, Maybe, they have sufficient assets in retirement, but they don't want to tap into those assets for going on a vacation or, gifting their grandchildren gifts to help them buy a home, or something like that. They haven't earmarked those income producing assets for those extra things. Okay. A reverse mortgage could be used in that regard. It can pay for things not in the budget, like I said, travel. It could be used in your financial planning. Okay. And I'm going to get into that with some of my realtor friends and how they've used it for their planning. And it can maximize cash flow, reduce taxes, and minimize risks. Now, again, I am not a certified financial planner. I am not a tax accountant. But if you bring to a financial planner the opportunity of having a reverse mortgage as a means for providing funds to you in a stipend arrangement or extra funds that you're living on, that allows the financial planner to hang on to those assets in those other accounts that could be, like Cindy just mentioned, her accountant has, or her certified financial planner has made almost 20% in growth on her assets by keeping them where they are. Well, the reverse mortgage rates are not 20%. So if you're paying less over here and you're earning more over there, it gives you the option of where you're going to be pulling assets from for your daily living. Okay. So pros and cons. It can be a source of cash flow, right? Because you can, if you've got significant equity, you can say, I don't need a lump sum payment, but I want $1,000 a month coming out of my house each month to augment my income. Okay. Well, if you take $1,000 out of your house each month on a reverse mortgage, that is not taxable income. Okay, because it's a loan. It's $1,000 that goes into your account as $1,000, right? You're not paying tax on it. It's not income because your loan is increasing. It's a lien against the property. You're just getting it in cash each month. And again, not having to make mortgage payments on the principal and interest. You still have to, again, pay the taxes, the insurance. If you've got a condo, you've got to pay the condo fees. And it's a non-recourse loan. So I'm going to define non-recourse later in the presentation, but just think of those words, okay? Basically, just non-recourse means the house will always satisfy the mortgage debt even if the debt is greater than the value of the house. So let me repeat it. The house, which remains in your name, will always satisfy the reverse mortgage loan, even if the loan amount at the time of the maturity event is greater than the value of the home. That's what the mortgage insurance monthly pays for. Okay. So we'll define that a little later too. Some cons are it's a minimum age requirement. Not everybody can get the HECM mortgage. You've got to be 62 or older, and you have to have significant equity in the property. By significant, I mean 60% or more. And we'll get into some charts on that. The older you are, the little less equity you need to have, but still 50 to 60% would be what you would be looking at. It's got to be your primary residence. It cannot be offered on second homes or investment properties. And again, interest and fees chip away at the home equity. It is negatively amortizing. Your balance is growing each month. Think about how your credit card works. If you made the minimum payment each month, your balance is going to go up next month. It works exactly like that. Okay. It works just like a credit card would be if you made minimum payments on it each month or didn't make a payment on it at all. It would continue to grow and your interest would compound. But some myths that we hear all the time. The bank will own my home. Absolutely not. You own your home. You're entitled on your home. You make all of the decisions on your home. This is just a different loan. That's all. What a regular mortgage loan is called a forward loan, this is called a reverse loan because the balance grows over time instead of goes down over time. Okay. My heirs will be stuck with a big bill. Absolutely not. You or your heirs will never owe more than the value of the home after the loan matures and the home is sold. Okay. So again, the non-recourse feature is the property will always satisfy the home loan regardless if the property is worth less than what the balance of the loan is. I have to own my home free and clear to qualify for a reverse mortgage. That is not true. It is a component of the value of the home, the age of the borrower, and the equity we have in that property to determine whether or not you would be eligible for a reverse loan. You can pay off the existing mortgage at closing using the loan proceeds. And there are calculators that I work up if you or someone you love is interested in looking at a reverse option, for a loved one. A lot of times I get the children of older adults calling us to say, I have one that I'm going right now, and the daughter and son-in-law called and said, look, mom is in a condo. She's 80 years old. She doesn't want to leave her condo. She's in good health, but her credit card debt is $30,000. She cannot keep up with what she's getting each month to live the life she wants to live. So in this case, this was an FHA approved condo, which was great. We were able to work on a reverse mortgage on this condo, and get her qualified so that she doesn't have to make those mortgage payments. And that would really help her then start getting down her credit card debt. So let's talk about loan qualifications. Again, 62 or older, you have to be the homeowner and you have to be living in the property. The property has to have significant equity. It's wonderful if there's no debt on it. Okay, then there's a whole lot of options we'd be able to discuss. But if there is a loan on it, we can extinguish that forward mortgage and replace it with a reverse mortgage as long as we have enough equity to cover the payoff of that loan and all the closing costs associated with a reverse loan. You should know that closing costs on a reverse are higher. Okay, they most definitely are higher. If you're in Virginia, I would say figure that your closing costs would be about 5% of whatever the balance of the new loan is going to be. And the reason for that is on this loan, FHA collects a 2% mortgage insurance premium upfront on the value of the property. So you could have a home that you own that's worth $1 million and no loan on it. And $20,000 of the closing cost is going to be upfront mortgage insurance premium based off of the value of the home. Okay. That fund is what help guarantees that even if you go underwater on this loan, your heirs would never be responsible for that gap between the value of the home and what's owed on the loan. Okay. So that's a significant expense on this. You've got to figure in Virginia, it's about 5%. You're going to add about 2% to standard closing costs. For example, DC closing costs run about 3.25%. So for DC, you're going to be about 5.25% in closing costs. Maryland, about 5.5%. So just so you have a sense, Virginia's a little less expensive. Must use the home as a primary residence, as I mentioned, and you have to meet credit and income requirements. So it's not running credit and income requirements traditionally like you would if you were qualifying for the home loan that you have now. It's more about what are the property taxes each month? What is the homeowner's insurance each month? What are the HOA and condo fees each month? We figure out a minimum of what utilities would be on your property based on square footage and a minimum expense for utilities. And then what are your pensions or income sources monthly that could accommodate those must pays? Is there a car loan? Is there minimum payments on credit cards? Like, can we meet those obligations based on what income we have coming in a minimal capacity? If we can meet those requirements, okay, then you should be able to qualify for this. Okay, so it's a different calculation. It's not like where we're taking on a forward loan, we would take your gross income, we'd multiply it by something, and then your monthly obligations can't exceed that number. We're not looking at it this way. We're looking at it from what we call a residual income calculation. Here's the money you get, here are the expenses. Do we have enough left for this family size in residual income each month? If we do, then you qualify. So it's just really a different calculation. You can use this on single family homes, 2 to 4 unit properties, as long as you're occupying one of those units. Townhomes, if it's a condo, it's got to be FHA approved. Sometimes the condo is not FHA approved, but we may be able to approve it for a single unit approval. There are some cases where we can do that. Planned unit developments, which are your normal townhomes with HOAs, modular homes, and manufactured homes that meet FHA requirements. Okay, all right. Okay, so how much home equity do you need, right? You basically need 50% or more to qualify for a reverse mortgage. When interest rates are higher, like they are right now, figure 60% or more. Okay. When interest rates are lower, there's more we can lend. So if interest rates start to come down, especially in the home equity space, which is what a lot of these are kind of, they kind of move like with the home equity rates, you'll have more opportunity to get a larger line. So for example, if the home was worth 400, you owed 100, there was 300,000 home equity. If we didn't have enough to cover the payoff of the loan and all the closing costs, we have had some cases where borrowers have brought cash to settlement just to be able to do the reverse mortgage. We have also seen them use this to purchase a property. They want to downsize and they don't want to have a payment in retirement. So instead of paying cash for the next home, maybe they put 60% down and the loan amount is 40% of the sales price, and they hang on to some of that cash and keep it invested over here with their financial planner. Okay. So the HECM for purchase is very popular as well. So again, we're basing the amount of the loan off of the age of the youngest borrower or non-borrowing spouse. And we'll get into a chart here soon. The interest rate you get on your loan impacts how much the loan is. So again, the lower the interest rate, the larger the line. And this is a line of credit. Okay. It's not fixed. It's a line of credit. The lesser of your home value or the HECM loan limit of 1.209750. So the maximum loan amount on this reverse mortgage can go as high as 1,209,000. I've had a financial planner call me and say, I have a customer who owns a $3 million property. He owes about 700,000 on it. He wants to retire. He's tired. I've been talking to him about doing a reverse mortgage. I said, well, have the ability to go to 1.209750. So if he wanted to extinguish his first mortgage, okay, and take that 700, convert it into a reverse, he would still have opportunity for it to grow over time. right? Because unlike in you're working with a buyer and you call me and you say, hey, we're looking in Spotsylvania County, what's the maximum FHA loan limit there? That could be far different than a high cost area like Northern Virginia that goes to 1,209,000. The HECM is 1,209,750 nationally. It doesn't matter where you are. That's the limit. So it's not just for those lower end properties or smaller properties. You could have a high wealth client that just is tired and doesn't want to make these payments on their mortgage, and they're sitting in this beautiful property and they just want to use their home as a different financial tool than using their assets over here, that once they withdraw them, they have to pay taxes on that money. So let's do an example. Let's say we have a borrower who's age 74. And let's say the expected rate, wishful thinking, is 5.5%, and the home value is 600,000. Okay. We have a principal limit factor of 45.8. So if you go over to the chart, you're going to look at 5.5%, the age of 74, you get a 45.8% principal limit factor, which is another way of saying maximum loan amount. So the available loan that this person could get would be 274,800. So they own a property, let's say outright, or maybe they have $100,000 mortgage on it. And I'm plugging in 74 years of age, a value of 600. We can obtain a reverse mortgage that will max out today in this minute at 274,800. Okay, so you could extinguish the 100, roll in the closing costs, and they would still have access on that line of credit up to 274,800. Okay. So how can we use those proceeds? Let's talk a little bit about this. Okay. You have three buckets of wealth when you start working, right? You have those years between 18 and 62 where you're earning. You've got your monthly bucket one, your wages, your commissions, your business earnings, your pensions, your social security, if you choose to take it at that time. But that earned income might decrease as you age, right? If you stop working, unless you've got mega assets that are driving returns to you at the same rate that you would have earned, your income typically would be declining in retirement. So you've got your nest egg, which is bucket number two. What have you saved over those working years, right? Is it 5 to 20% that you've saved for retirement? These are things like your 401ks, your IRAs, your stocks, your mutual funds, your life insurance that might be paying out to you, etc. That is your supplemental income. Okay. So you might have your pension or retirement income here that is your stipend that you get each month. But then have you set up your distributions from these retirement funds? Okay. And every time you distribute, if it was in an account that you didn't pay taxes on its growth over time, when you take the money out, you will be required to pay tax on any gains, right, that you've pulled out. And then you've got bucket three, which is your home, right? You made a down payment on it, you have equity in it, right? What is that equity doing for you? Well, it might make you feel really good to have it, right? Maybe that's something you've earmarked to leave to your children is the house. But do your children really want the house or do they want the money? Is the house going to be a burden to them to sell and get the money out of? Or would they rather not have the house and have the assets instead? Right? It's just a question you need to think about. So, how can you take that mortgage proceeds from the reverse? Well, there are ways to take a single disbursement lump sum at closing. So much like if you were doing a cash out refinance and you were like, I need to take cash out of the house because I want to do X, Y, or Z, to rehab the house. You can do a single lump sum disbursement. You could do it in fixed rate monthly advances, which is, I did this for my mom. I did both. We set up a reverse mortgage for my mother and she got some lump sum at closing, and she also got a fixed rate advance at closing because she wanted to do some repairs on the property. So there's a lot of things that, a lot of different ways you can do it. You can take nothing at closing and just set it up as a line of credit, right? Or you could do both. So, to give you an example, my father passed away in 2006, and at that point, my mother's Social Security was cut. My parents never really had anything. Very humble kind of beginnings. So she was stuck. She did get his Social Security, which was more than hers, but she had been living in our house since 1960, and she needed more a month, and she owned the home outright. Okay. So at the time, she said, Kelly, I really want to put a new roof on the house. We had a freestanding two-car garage. I want to put a new roof on the garage, and I want this much per month. Well, my mother enjoyed this reverse mortgage for 16 years, getting a stipend each month that made up for what she lost. She aged in place in that house. God bless her. Next weekend, she's going to turn 94. But we decided to sell that house last December, and she still walked away with profit. Even though it negatively amortized over 16 years, she got money out of it. She lived the way she wanted to live. She's in great shape, but it's just too much at 94 to take care of the house by herself, you know. So she's moved in with my sister. But that's a real world example of someone who saw the benefit of this and didn't burden her children with, I mean, not that we didn't contribute, but it let her stay in control of the decision making of her life, okay, as she aged. The unused portion of that line of credit will grow over time. So it grows at the same compounding rate as the loan balance. So where you start on your loan today, your loan amount is going to look very different 10 years from now. And we show all of that to you, assuming certain things over time, right? So that line of credit will continue to grow. There will be greater borrowing capacity over time. It's secure as a line of credit. It can never be frozen or capped. So remember, like in 2008, you had this big, upside down market that we were in, right? All of a sudden, houses in our area devalued. Banks were canceling lines of credit or shortening your access. You had $100,000 line of credit, and suddenly your bank calls you and says, guess what? Your line of credit is capped or frozen. You can't access it anymore. Or we've reduced it to $50,000 instead of 100,000. Like that was a very real thing that happened in our industry. In a reverse situation, it can never be capped or frozen, and it will never be reduced. So as it grows over time, it will always be there. So if you used this line of credit, you tapped into it, and you paid it back. You decided to make a payment on it. You're not required to, but let's say you decided to, you still can write checks against it or access it again up to wherever that maximum is. And you would get a notice every month on your statement. Yes, you get mailed statements on this product to tell you exactly how much you can access at any given time. Okay. So you can use it, borrow against it, pay it back, and borrow again. Like some of our real estate friends, because they are commissioned in the way that they make their living, they say, Kelly, I'm on a reverse mortgage. I never know how much money I'm going to make each year based on many factors in the market, right? So, what I want to do is I don't want to make any mortgage payments all year long. And when I get to November, I'm going to decide if I want to take any of my income and pay it against my line of credit. And I always say November because you want to do it by November so that when you get your interest statements at the end of the year for filing your taxes, you want to be sure that's captured before the end of the year so that you get your interest statement for your tax preparation, right? So you make the decision in November. So, you might have someone saying, well, I have a $200,000 reverse mortgage. At the end of the year, the balance grew to 210. I'm going to throw $10,000 against it. So starting in January 2026, I'm still at 200. I'm comfortable with it staying there. Whereas if it's a bad year, they might not put anything against it, but you have that choice. You have that flexibility of deciding when to make a mortgage payment if you want to or not. Okay. The line of credit will grow over time. It just lets you know. So let's say you had a 62-year-old borrower, the home value was 600. Let's say the line of credit in this example was 223,506. Well, if you went 27 years later and extrapolate out what that home might be worth, it could be 1,024,000. The line of credit would have grown to 1,026,000 by that time. So again, they could access it, pay it against it, but it's still going to grow. It's not going to shrink. It's not going to reduce. You can use a HECM reverse mortgage again to extinguish the current mortgage and get rid of the principal and interest payments. You can use it as a line of credit, kind of as a standby protection to your portfolio. So what I mean by this, you can use that reverse mortgage to enhance your cash flow in economic downtime. So let's say stocks have taken a beating and you're in retirement and the last thing you want to do is pull money out of your portfolio in a downturn. Well, you might be using the reverse line of credit to live on and leave your stocks over here so that they can rebound and grow again. And you're using this pocket of money to live on over here on the reverse instead. Okay, you have that choice. What's the best avenue of where to take my funds from? Okay, for my daily needs. It can stretch those assets for you because it works in reverse. You're in a high yield, like Cindy was saying. I'm making 20% on these assets over here. Well, if the HECM is priced at 6.5, why wouldn't you pull money out of that and use your home? Because your pay rate on it is 6.5%, but your earn rate over here is 20.
Can I say something real quick?
Yeah,
Also, and I'm not a tax advisor. I'm just
right.
relaying what
Neither
my
am I.
own person said to me. Okay. But when you're pulling stuff out of your IRA, it's taxable.
Right.
So, that's a real advantage if you start really figuring out the numbers,
Hmm.
So anyway, I just thought that to me is the biggest bonus.
Right. Because I mean, look, it's a loan, but any money you distribute monthly is tax free because it's not income. It's a loan. You're borrowing against your house. We're
Right.
just
And
paying
if
you
you're
through
on
a
Social
different lens.
Security
Right.
and you have to stay under a certain umbrella.
Right.
So let me tell you what, there's a lot of advantages to this that people can't just look at the one thing, look at the whole picture
Correct.
on planning.
Correct.
That's why it's so great. Well, the
Correct.
FHA one is, yeah.
Yeah. Yeah. So a lot of flexibility here, and you would talk to your tax person to help guide you in what makes the most sense. But I just want people to start thinking about their home differently because it's not, I mean, yes, it's hearth and home, but it's also strategic. It could be very strategic, and the savvy investor is going to get this right away, in determining it doesn't make sense for them particularly. You can increase cash flow to close a retirement income gap. Like for me, I turn 62 next month. My age for maximum Social Security is now 67. Okay, it wasn't 67 when I was 18 years old, but it's 67 now if I want full benefit, right? Well, if I decided to retire in advance of 67 and not start Social Security, I could use my reverse mortgage to close that gap. It could help me pay for my insurance costs, right? My health insurance costs. It could help me monthly for, as an income source for me or cash flow source for me monthly, and then defer, me taking Social Security until I hit that 67 years of age if I wanted to, right? It's getting people to think about, well, do I really want to wait till 67 to retire, or do I want to go earlier and use this instead? So people use it to give gifts to kids, to help them, purchase homes or help them through college. You can use it to help pay for renovations that you don't have to make payments on, right? You could take your cash disbursement and, you know, fix your house up so that you can age in place based on your health needs. It could help you pay for long-term insurance premiums, which are no joke. I mean, long-term care premiums are a fortune, okay? Or in-home care premiums. For example, like if you have home health care, the average cost of that is almost 60,000 a year. If you're in an assisted living facility, that's about 54,000 a year. And private nursing care, over 100,000 a year. So, Medicaid is only going to pay for shared rooms, and 95% of people have no long-term care insurance, and 50% will need it. So again, it's a different way of thinking about, how to use your home as you age. So financial planners, again, it could help you keep that adjusted gross income low because any monies you pull out of the house are not considered income. It could help you make your traditional funds last longer, as we've been talking about. It can provide a hedge for you. Maybe this month is a good time to take losses and take money out of something, whereas next month is not, right? So it gives you that choice to work with your financial planner. Help pay for the long-term care, and again, maximize other retirement contributions. So why should you start this sooner than later? Okay. Why do it at 62 and not 82? Well, Sachs and Sachs coordinated strategy says if you open a line of credit or reverse mortgage early, right? Statistically speaking, you have a 78% cash flow survival rate in retirement. That assumes a 4% post-tax initial withdrawal rate based on a 32-year investment return. So taking it out from 62 out to like 94. Okay. If you use a reverse as the, last resort strategy, I've depleted all of my other assets. Okay, now I'm going to do a reverse, and you open this up after everything's depleted, your cash flow survival rate in retirement drops from 78 to 60%. Again, assuming the same post-tax initial withdrawal rates. Okay. If you ignore it altogether, you never pull a reverse mortgage out, you're proud, you own the home free and clear, which is an accomplishment. Trust me, believe me, I understand that. But your cash flow survival probability in retirement drops to 35%. So where are you going? Are you selling the house? You moving in with your children? What are you doing at that point if you run out of money? And this is just a chart that displays everything we just talked about here. So I'm not going to spend a lot of time on this one. But this particular loan, the HECM, through the Federal Housing Authority, has the most consumer protections for you and your heirs, okay? The borrowers have to receive counseling from a HUD-approved agency, not me. It's independent, so they want to be sure based on, that we're not taking advantage of seniors, that they do understand how the product works. There are initial disbursement limits, and this was put in place because people were taking out reverse mortgages and getting all of their money. So they're like, okay, I have $1 million property. I want all $400,000 at closing in one lump sum. Well, then they stopped making their property tax payments and insurance payments, and the house would go into foreclosure. And then what? The loan is in default, right? So there are limits of how much cash you can get in the first year on the line of credit. But then once you get to month 13, the rest of the line of credit opens up and the borrower has access to it. Okay. We do a financial assessment. There are protections to the non-borrowing spouse, meaning that if the age 62 or older borrower passes away and you have a non-borrowing spouse who's not on the loan but is on title to the property, there are protections for them to remain in the property. The line of credit is secure and the unused line of credit grows over time, regardless of the value of the home. Okay, so the line of credit could be larger than the value of the home. And again, the non-recourse feature, meaning the house will always satisfy the loan regardless if there's a gap in what it's worth to what is owed. So you can, of course, use this to buy a home. You know, you want to upsize, downsize, right size. The primary reason people will use a reverse mortgage is to downsize to be closer to grandchildren. We'll work the numbers up to see what size down payment you would have to use in a reverse for purchase. But very clearly, you can use this to purchase that last home or any home and not have a monthly payment. Again, there's no escrows on this, so you're paying your taxes and insurance on your own. Okay. There are some what we call proprietary reverse mortgages. Some banks want to get into reverse lending and they create conventional reverse products out there that are different than the HECM. They cater to very high property values, specifically. Maybe it's a non-FHA approved condo complex. It could be their age 55 and not 62. Some banks set up reverse mortgages when they hit age 55. And they don't like the mortgage insurance premium options. So there are proprietary conventional loans that we can look at. They're not available in all states, but sometimes we do get a request to say, hey, we really want to look at a reverse mortgage. We're 57 years old. We live here. What can we do? And we'll look and see what might be available there. So what happens at loan maturity? This is a maturity event when the loan becomes due and payable, right? You want to sell your home. Well, just like any other loan that's attached to a property, you've got to pay it off, right? In order for title to be clear to transfer, the loan's got to be satisfied. So you could sell your home. If you transfer title of that property to somebody else, that's a maturity event and the loan is called. Okay. The last surviving borrower moves out of the home permanently. So you have a borrower who, let's say, needs to move into assisted living permanently. They can't age in place any longer. That is a maturity event. They are no longer going to be occupying that home as their primary residence. They're going to be at a long-term care facility. That is a maturity event. If they default on the loan terms, they stop paying their property taxes, and now foreclosure proceedings start because the tax authority has said, hey, you haven't paid your taxes. We're going to start foreclosure proceedings. That's going to be a note due and payable. Or the last surviving borrower passes away. That obviously calls the loan. So how is it repaid? If the loan is not yet due and payable, the borrower can pay as little or as much as they want toward the balance. They're not required to make any payments. If they want to pay against it, that's totally fine. There's no prepayment penalty. If they make no payments, they just pay their taxes and insurance, they're fine. If the maturity event happens like we discussed on the previous slide, the loan is payable and it's typically satisfied by the sale of the home. The non-recourse feature of the loan means that the sale of the home will always satisfy the loan repayment obligation, and neither the borrower nor the heirs will be personally liable for any balance deficiency. So let's look at the next slide. That'll make this a little more clear. What happens to the heirs who inherit this reverse mortgaged home? Okay, well, there's two questions. Is there equity left in the property? And do they want to keep the home? So if the answer is yes, there's equity in the property, they can pay off or refinance the loan balance, right? And keep the home. If there is equity left in the property, but they don't want to keep the home, they can sell the home and pocket the profit, just like any other house, right? But let's say there's no equity left in the home and they want to keep it, they want to buy it, right? They can purchase the home with a short payoff of 95% of the appraised value of the home. So let's assume that the house is worth 400,000. Let's assume that the balance of the loan is 450. The buyers or heirs can purchase the home at 95% of 400,000, right? So that shortfall of what's due on that loan is not their responsibility. So this is a way that they can keep that house in the family and buy it for 95% of the appraised value of the home. If they don't want to keep the home and they're underwater on this house, they literally can sign a deed in lieu of foreclosure and walk away from the home. They don't have to do a thing. They can just sign it over to the bank. The bank will sell it, do whatever they need to do with it. Okay. Any questions on that? So it has those protections for the heirs. Okay. One thing you should know that if something happens and the maturity event occurs, typically the servicer on that loan expects their money in 30 days. Unless you contact them and you tell them the heirs want to keep the house or we're going to sell the house, because there's an extension you have to apply for. You'll get 6 months on the first extension, and you are eligible for a second extension for another 6 months. It's just about communicating with the servicer of the property and what you're doing. Okay. And again, just why Fairway? We're just a national full service lender. We do all of the work on the reverse mortgages from start to finish. Again, I just really want everybody to think about this differently, talk about it, think about who you might know that wants more information on this particular program, because it could open up a lot of opportunity for you and your loved ones in what they can do and live their life a little differently. Just from personal experience with my own mother, it changed her life. I mean, short of us having to have supported her to stay in that home, which we did in other ways, believe me, at least from a monthly cash flow scenario, she was in control. And that meant everything to her. And that is all I have. I'm right on the money here on time. But if anybody has any questions, anything I can answer for anybody, would love to hear from you.
Kelly,
Yes.
just briefly, what are the mechanics of purchasing a home with a reverse mortgage?
It's no different than if you were applying for any other loan. It's no different. So if you said, I want to buy this next house with a reverse mortgage, it's going to be an FHA appraisal on that house. It's going to be a regular loan application, although I'm qualifying you differently than what you're used to. You're still providing income documentation. There's still a credit report that we run. But we're not looking for bank statements necessarily, short of what we need to see to cover down payment and closing costs, right? If you're selling a home and all of the money is coming out of those proceeds, then we're going to condition that the home be sold and we show all of those proceeds being used. But it's the process is only slightly different than if you were applying for a regular home loan on that in the normal way. It's really no different. It's just an FHA appraisal process. Like some people want to know, what's the difference? Well, the methodology on an FHA appraisal is no different than the methodology on a conventional appraisal. But you do have an amendatory clause because it's an FHA loan, right? If
Right.
it's a condo, it's got to be FHA approved. It's those types of things.
Okay.
Mhm. Any other questions? Well, and I'll send the slides out of this afterwards. And if you have any questions or you just want to run some numbers, say, hey, Kelly, I have someone, this is how old they are, this is where they live, this is the value of their home. What could they get on a reverse? That's a quick calculation we can do before you start talking all this up. Let us see how we can help and we can go from there.